Welcome to the deep dive. Today we're really digging into the Cleveland Elyria Mentor MSA Industrial Market Report. This is for the second quarter of 2025. And our sources, well, they paint a really interesting picture. There's this incredible tension. You've got some positive signs like economic stability, maybe some modest job growth, but then bam, the industrial real estate market posts this like historically abrupt contraction. It's pretty jarring. So our mission today is to figure out what really drove this quote unquote historic low performance this quarter, and maybe more importantly, what signs of adaptation, what strategies are starting to emerge. Where does the market go from here?
It really is quite a disconnect, isn't it?
Yeah.
It's just a closer look. We have to look beyond, the shock of those real estate numbers. We need to connect them back to the bigger picture, the macro economy. I mean, if the job market is reasonably steady, how did absorption just, crash so hard? Was it a systemic issue or maybe something more concentrated? A temporary blip, perhaps?
Okay, let's start there with that economic backdrop, because like you said, it's not all bad news. Looking at the basic data, Cleveland's overall non-farm employment actually went up. Annually, it increased by 0.5% in May 2025. Now, it is growth, but when you compare it nationally, the U.S. was at 1.1%. So Cleveland's maybe stabilizing, but definitely lagging behind the national trend a bit.
And the unemployment rate, it kind of reflects that stabilization too, even though it did tick up slightly. It moved to 4.2% in May, which is just 10 basis points up from April's 4.1%. But, and this is crucial, that 4.2% actually matched the national rate for May, and it came after 3 straight months at a steady 4.0%. So the labor force doesn't seem to be panicking. It looks more like a slight, maybe managed adjustment.
Right. Okay, now here's where maybe the first piece of the puzzle starts to fit in, or maybe not fit in, the industrial adjacent sectors. The signals are really mixed here. Construction, it gained a little, modest 0.4%. That's okay. Manufacturing, the bedrock for the region, managed a small increase too, 0.2%. But then you hit the trade, transportation, and utilities sector, TTU. That's the lifeblood of industrial real estate, right?
Yeah.
And it declined, down 0.5%.
Yeah, and that TTU decline, that's a massive red flag. We're not just talking about like one bad quarter. That sector has actually shown negative growth for 16 months straight. 16. That duration points to some persistent underlying stress. Problems in local logistics, warehousing, transport services. It kind of tells us the systems for moving goods were already feeling the strain well before these big real estate closures hit the headlines.
Sure. Okay, so manufacturers, they're showing some resilience. They're still building things. But the infrastructure, the TTU sector, needed to move those things. That's weakening. Why the split? How is manufacturing managing that 0.2% growth amidst this?
Well, that manufacturing resilience, it's not just happening by accident. It seems to be driven by specific strategies. Our sources suggest local manufacturers are really leaning into things like nearshoring, bringing supply chains closer. And they're also investing in automation, rebuilding inventory levels. They seem to be deliberately adapting to all the global instability, trying to control what they can locally. And that's providing a bit of a positive counterweight against the turbulence we see on the distribution side.
That makes sense. So manufacturers playing defense, logistics sector shrinking. Does that pain in logistics translate directly to the real estate numbers? Let's look at absorption, because honestly, these numbers are alarming.
Oh, they absolutely translate. This is the headline you just can't miss. The Cleveland industrial market posted a really steep negative absorption. We're talking negative 2.8 million square feet in Q2 2025. That metric, the net change in occupied space, it was the lowest quarterly result they've seen in recent history. Just wow.
Negative 2.8 million, okay. And what did that sudden, huge dump of space do to vacancy?
Well, it triggered a pretty massive swing. We saw a full 100 basis point increase just for the quarter. That pushed the industrial vacancy rate up to 5.2%. However, and we really need to give the listener this context, the historical long-term average vacancy for this region is actually 7.4%. So yeah, 5.2% is a jarring jump for one quarter, but it's still historically tight, which suggests this quarter might have been an extreme sort of concentrated event, not necessarily the start of a total market collapse.
That's a really important distinction, and we can actually point fingers, can't we? The main cause for this downturn, it was just a handful of really big, high-profile closures and move-outs. The single biggest one was JOANN Inc., shutting down that massive, massive facility, 1.2 million square feet at 54555555. Darrow Rod. Wait a minute, though. Just JOANN's closure, that's nearly half of that huge negative absorption number right there. So are we really talking about a fundamental Cleveland industrial market failure, or is this more about a major corporate retail bankruptcy problem spilling over?
That's exactly the nuance we need to grasp here.
Yeah.
It really was concentrated pain. I mean, Joann's huge vacancy, it definitely skews the metrics for the whole metro area, no question. But you also have to stack that alongside True Value closing over 400,000 square feet. Harvest Sherwood Distributors vacating almost 300,000, Worthington Steel closing over 260,000 square feet. You add just those four blocks together, and you're looking at, what, over 2.1 million square feet hitting the market in one quarter, largely because of corporate financial distress, like you said, bankruptcies.
Right. That kind of shock, it really needs a strong demand story on the other side to balance it out. Did we see any signs of life, any rebound in actual leasing activity, even with all that space suddenly available?
Fortunately, yes, there was some positive movement there. Leasing activity did recover a bit after hitting a real low point earlier in the year. It bounced back to 2.00 million square feet in quarterly leasing volume for Q2. So that does suggest there's renewed activity, some underlying demand still there, which is, a positive signal for the second half of 2025, even if, obviously, that activity wasn't nearly enough to instantly absorb those massive move-outs we just talked about.
Okay, let's talk specifics then. Who was actually signing leases? Who was betting on Cleveland during this time?
Well, the headlining deal, the really big one, was Piping Rock Health Products. They signed for just over 408,000 square feet at Turnpike Commerce Center. That's a huge lease.
Wow, okay. Significant.
Definitely. And then additionally, we saw Intimate Brands take down nearly 80,000 square feet, and Piston Automotive moved into a pretty significant 175,000 square foot space. So these deals prove that, yes, large-scale demand is still present, but it does seem to be highly selective right now.
Highly selective. And maybe part of that selectivity is because pricing is clearly suffering, right? With that huge inventory dump from Joann and the others, how badly did rents get hit?
Yeah, they definitely took a hit. The industrial direct average asking rent, it contracted year over year by negative 3.9%. And that's a noticeable acceleration of the contraction compared to the negative 2.8% we saw back in the first quarter.
So getting worse on the pricing front.
Right. The average asking rent for Q2 actually landed at $5.88 per square foot. That's down about 0.14 cents per square foot just from the previous quarter. And this, I think, tells a story about market segmentation. That lower average rent is likely being dragged down by older, maybe less efficient, often very large blocks of space, exactly the kind that these bankrupt retailers left behind.
Ah, that brings up a really interesting point about quality then. Because even with the average rent dropping, there was still clear strength at the top end of the market, wasn't there?
Absolutely. It's almost like two different markets operating at the same time. Class A, modern warehouse facilities. They were a key driver of the leasing activity we did see. They accounted for, 32.3% of all deals in the first half of 2025.
Over a third.
Yeah, which suggests that businesses might actually be using this overall market volatility as a chance to upgrade, maybe shed older, less efficient legacy spaces and move into something modern. Demand for facilities with high clear heights, better automation potential, strategic access that seems robust, even if the overall market mood feels negative.
Okay, let's zoom out a bit and talk about the why. Why did Joann Inc. close? Why did the market sort of seize up like this? You mentioned corporate debt earlier. How exactly does that lead to a vacant 1.2 million square foot building?
Well, it's often a direct consequence of rising debt costs, rising interest rates. When rates go up, corporate debt gets more expensive to service, right? And that financial pressure can push highly leveraged companies, especially retailers like Joann or maybe Big Lots, towards bankruptcy protection. And in bankruptcy, one of the fastest ways to raise cash and cut liabilities is to liquidate your big assets. And massive real estate holdings are often top of the list.
So the lesson is interest rate hikes aren't just about mortgages.
Exactly. They ripple out, they hit corporate balance sheets, cause major companies to shed huge properties, and that instantly floods the local industrial market with space.
And it's not just internal factors like corporate debt, is it? There's the global context, too. We still have ongoing tariff uncertainty, shipping delays persist, raw material shortages are still a thing.
Right, all contributing to global production slowdowns. Plus, you have to remember that massive pandemic-fueled e-commerce boom, the one that needed seemingly endless warehouse space, that's clearly tapered off now.
So this whole mix of factors, it seems to be forcing a change in strategy, doesn't it? In logistics strategy.
It really is. Companies seem to be moving away from that old reliance on super lean, just-in-time delivery. The assumption that product would just arrive exactly when needed. They seem to be adapting now by front-loading inventory.
Okay, let's pause on that term, front-loading inventory. What does that actually look like? Why is that the strategic play right now?
Well, it basically means they're intentionally building up a strategic buffer. a safety stock. So instead of ordering just enough product for their immediate needs and relying on fast global shipping, they're ordering and warehousing maybe 6, maybe 9 months worth of critical stock now.
Okay, building up reserves.
Exactly. And they're doing it for, well, mainly two reasons. One, to potentially avoid the impact of new tariffs that might come down the road, lock in the costs now. And two, just to build more reliability into their supply chain, given all the persistent logistical bottlenecks we've seen. It's a strategic shift from just-in-time to more of a just-in-case model.
And how does that shift, that just-in-case model, affect the physical real estate market here in Cleveland?
Well, it changes the nature of the demand, I think.
Hmm.
While overall demand might slow down a bit because, e-commerce isn't expanding at that crazy pace anymore, the demand for large, modern, and probably highly secure facilities, the kind needed to hold that expensive strategic safety stock, that demand actually increases. And that might explain why we're still seeing strong leasing for Class A spaces, even while the overall average rent is declining. Companies still need space, but they need the right kind of space for that long-term valuable inventory.
Okay, so if companies are adapting like this and there's still selective demand for the right kind of space, you'd think maybe we'd see a pipeline of new construction trying to meet those Class A needs.
Mm.
But our sources show the supply pipeline is actually tightening up.
It is, yeah. The volume of industrial space actually under construction fell pretty significantly, down to about 2.4 million square feet, which sounds like a lot, but it's actually a tiny fraction, only 0.8% of the total existing inventory. And it sounds like most proposed projects, things not yet started, are facing delays getting off the ground, probably due to financing costs and general uncertainty. So the near-term outlook for significant new supply seems kind of on hold right now, which effectively caps future expansion possibilities. It means the speed of market recovery will be determined almost entirely by how fast that existing 5.2% vacancy rate can get absorbed, can get backfilled.
Yet, despite all this volatility, the negative absorption, the stalled pipeline, investors are still putting money into the Cleveland market. We saw some key sales transactions this quarter.
Absolutely. Capital is still flowing towards quality assets. We saw Tuffley's purchase of that two-building portfolio. It was 42,400 square feet, and it sold for $6.1 million.
Okay, and what does that break down to per square foot?
That came out to a very high $142.69 per square foot, and it closed with an 8.25% cap rate.
Wow, $142 a foot. That price seems really high, almost counterintuitive given the huge negative absorption number we were just talking about.
It really does, doesn't it? But I think it shows where investor confidence lies right now. It's in the quality of the actual asset, the location, not necessarily in the short-term quarterly market turbulence. And similarly, we saw Sealy and Company make an investment purchase too, a 98,000 square foot facility for $8,250,000. These aren't distressed sales prices. These look like strategic bets on the long-term value of well-located regional industrial assets.
Okay, so if we try to synthesize all this for you, the listener, trying to navigate this complex environment, what's the main takeaway here? It seems like Cleveland's second quarter was really defined by that massive, very concentrated pain from retail bankruptcies, the Joann effect, basically. That's what created the historic negative absorption. But if you look beneath that surface noise, there does seem to be genuine strategic resilience. You see it in local manufacturing adapting, and you see it in that robust, although selective leasing recovery for the high-quality spaces.
Yeah, I think the market is definitely going through a necessary adjustment, maybe a painful one in the short term, but necessary. It feels like a shift away from that opportunistic, almost frantic e-commerce warehousing boom we saw over the last few years. And it's moving towards a more disciplined approach, one focused on, like we discussed, long-term strategic inventory management and maybe more localized production through things like nearshoring.
Okay, so given all this complexity, the market shedding older space while investors are paying premium prices for modern assets, here's maybe the provocative thought to leave you with. We know Class A leasing is holding up, and we just saw investors like Tuffley paying that high $142 per square foot price. Does that premium price suggest that major investors really believe this trend of companies front-loading inventory, building up safety stock because of tariff uncertainty and logistics issues? Do they believe that's a deep, maybe permanent structural change in how logistics will operate going forward?
And following on from that, if that demand for high-quality, strategically located space is truly resilient and potentially long-term, the ultimate question for the Cleveland market then becomes, how long can that current, quite shocking 5.2% vacancy rate actually last? Before the lack of new supply, combined with this need for strategic buffer stock, starts pushing vacancy back down towards that historic tightness we talked about. It really suggests investors might be looking completely past this quarter's chaos, focusing on a very different future demand profile.